Today we're going to learn the two of the first, like, the most widely used valuation models in the industry: discounted cash flows and residual income. So we have to do discounted cash flows and residual income. First, we have to understand the time value of money calculations, and then we're going to go over how to calculate free cash flow to the firm. And then after that, we're going to go through what residual income is and how to calculate it. So the common thing you think of with time value of money is that $1 today is not worth the same as what it is tomorrow. So that equation right there is the present value of something. So you have your cash flow at the next day, the interest rate on the cash, or what it's going to be discounted by underneath of it, and then that compounds for the number of periods. So a quick example of it is you're expecting a payment of $1,000 a year from now, and there's about 3% inflation. So what you do is you plug that into the present value equation. So the cash flow tomorrow at the top, 1,000, and then 1 plus the interest rate of 3%, and then because it's 1 year from now, you're going to raise it to the first power. And that $1,000 that you're going to get tomorrow is actually only worth about $970 in today's money, according to inflation. Now, if you did it 2 years out, for example, it would be 1 plus 0.03 squared. So that would give you like roughly 6.1% instead of 6 because you're compounding that. So that's like, that present value is kind of the basis of a lot of the discounted cash flow assumptions. And for residual income, when you project out multiple years, you have to discount everything to what it's worth today. So the next step, now that you know how to get the present value of something, you have to know how to get to free cash flow to the firm. So the free cash flow to the firm is simply, it's the earnings before interest and taxes, then you're going to take taxes off that. So that's the earnings before interest, effectively. Then you're going to add depreciation back into that, because depreciation actually doesn't deduct anything from the cash flow you generate. That's just an accounting thing that says the value of what you own is worth less over time. So that expense item on the balance sheet, you're not losing cash based on that. Then you're going to deduct capital expenditures, which is the purchase of property, plant, and equipment. So whenever they buy new factories and everything, those capital expenditures don't actually affect the cash flow that the firm can generate, so you need to take those out. Then you're going to deduct the change in non-cash working capital. And that sounds kind of complicated, but all working capital is its current assets minus current liabilities. And then so non-cash working capital is you have current assets minus cash minus current liabilities. So last week when we forecasted out all the balance sheet and income statement, we can actually take this free cash flow equation. We can apply this to year 1 through 5. So if this year's 2018, we forecasted through 2022. We're just going to take this equation, we're going to apply it to 2018 through 2022 and figure out what the free cash flow to the firm is going to be in every year. Next, we're going to go through and we have to take all the ones that are after this year and discount them using the present value equation. So the 2019 cash flow, we're going to take whatever we had in 2019 and divide it by 1 plus the company's weighted average cost of capital, which we calculated 2 weeks ago. The reason we discount it by the weighted average cost of capital is because that's the cost the company can expect to pay to finance making those cash flows. So it's going to use its mix of equity and debt to get what it needs to finance generating the 2019, 2020, 2021 cash flows. So now I'm going to show you on the spreadsheet kind of what it looks like and how I've set this up. And I'll share this one with you too so you can see. So what I did for 2018. So first I linked the EBITDA over to the 3-statement model. And then I also linked the earnings before interest and taxes over to the 3-statement model. So those are already calculated from last week after applying the growth rates. We just link them in here. The next thing we're going to do is we're going to take the tax rates. Those we found out the first week through the company's 10K, or we went ahead and we actually calculated what their tax basis is and then figured out the tax rates. So those are the 2 ways to do that. And And then we're going to take the earnings before interest and taxes, not EBITDA, and multiply it by 1 minus the tax rate to give you kind of the earnings before interest, but after taxes. And then this formula in here, let me zoom this in a bit for you. So in here, you can see what we did is we took the earnings before interest after the taxes, we add the depreciation expenses back in to get the actual cash it generated. We're going to take out the change in non-cash net working capital, which the reason theirs was so high is because they had a reduction in short-term investments going into 2018. And you're going to find things like that where if that number looks a little high in 1 year, that's why we took the average when we forecasted it to kind of smooth that out, because they're not always going to have a 50% drop in non-cash net working capital. And then we're going to subtract out also the capital expenditures they had when they reinvested into their business, which gives us about $17 billion what's unleveraged free cash flows. And because it's in the current year, so when we're looking at 2018, we look at that as the results from now. We're not going to discount that. Those cash flows already happened. We can kind of figure it out what those free cash flows are worth. Now, 2019, same thing. These are all linked over to the three-statement model. So when you do this in Excel or in here, when you have them all linked, you can simply just drag the equation right across, and it'll fill out from 2018 to 2022. And you can see over here I have, it'll just drag across EBITDA, earnings before interest and taxes, depreciation's a line item on there. When you look at the non-cash working capital, what I did is actually calculated it on the other side of the sheet, so I could do the same thing and drag across. That's like generally the best practice when you do this. You want to have everything pre-calculated on one sheet, so you're dragging your formulas over on another sheet. So that way you're not like, you don't have cells with these massive formulas that you can get mixed up on. So yeah, it's just the sum of the non-cash current assets minus current liabilities again. And then to get the change in it, you just subtract this year from the last year, and that's kind of the change year over year. So those are all linked up, drag them across. The discount rate was calculated as the weighted average cost of capital in the first week. So we'll put that at the bottom, and next we'll use the present value function. And the simple way to use this present value function, the equation's right here. When I share the sheet with you, you can use this over and over again. All it does is it takes that equation that I wrote up on the board earlier, and it puts it into a much easier to write Excel function rather than you trying to get the cash flow and divide it by 1 plus the interest rate, and then you use the exponent key to raise it to whatever power. This does all that for you. So over the course of 5 years, you're going to take all the present values of free cash flows, and then it's important to add them up. That's going to be that's about, well, in this case, about a third of the value of this actual company is the cash flows that it generates. Now, when you do a discounted cash flow model, what they'll teach you in school is to use the Gordon growth model and assume that the company grows forever at a certain growth rate. You can do that and use that as your kind of end value, but for our purposes, we don't want to do that, because that's more of like in an academic setting that works, but in practice, the company never grows forever at 3%. That just doesn't happen. So what the industry standard to use is what's called an exit multiple. So if we go onto Bloomberg, we're going to look at this screen called the EQRV screen. Right here, we're going to set it to the Global Industry Classification Standard, GICS, and we're going to look at the sub-industry, so all the soft drink companies. And this number right here, enterprise value to EBITDA, this is the multiple that you use to get most of your company's value. So in year 5, to kind of tie off the valuation model, you're going to take the EBITDA from year 5 and multiply it by the industry average multiple. So what you're saying is, in year 5, we're pretty confident that for every $1 of EBITDA, you pay about $15. That's, yeah.
Why don't you use PE? Is it because, why?
So you could, the PE multiple, when you use that in a valuation, typically when you're forecasting earnings, you'll just take like the next year and multiply it. Mm-hmm. I mean, if you wanted to try it in a DCF, you could. It's just, the best like accepted practice is to do it with EV to EBITDA. Because when you think about the EV to EBITDA calculations, the easiest thing to forecast on the income statement is EBITDA. Because all it is net income minus cost of goods sold minus SG&A and other overheads. So you're only forecasting 4 items. PE, you're forecasting all the way down the income statement to earnings per share.
Mhm.
Plus you have to forecast the number of shares outstanding, because the shares outstanding is going to change to get like price to.
Would that be like a method that would look good if you were to do it, but it's just a shortcut? Or
Yeah, it
is
would.
kind of
I mean, it would look good if you tried to do it, but it's easier to get this more accurate than that one. That's kind of.
Oh,
Yeah, it's
okay.
like the whole point of this is you're forecasting 3 items, and you're going 5 years out, which like 5 years out is already a question mark.
Mhm.
So you'd rather forecast 4 items 5 years out than 15 items 5 years out is like the long and short answer.
Okay.
So that's why that's like the generally accepted method to use. So, and a 15.2 times multiple means that you're simply paying $15.2 for every dollar of earnings before interest, taxes, depreciation, and amortization you generate. So in Coca-Cola's case, I took that 15.2 times multiple that's the industry average. And you're actually going to multiply the EBITDA number for the last year times 12.4. So all I did is I typed out the multiple I'm using here, or this should be 15. So you're going to multiply that multiple by the EBITDA in the last year. So that kind of ties it off. That says at the end, we're pretty sure we're going to pay about 15.4 times what the company's going to generate in 2022. Next, we have to take the present value of that. So present value equation again, weighted average cost of capital is our discount rate, and that's kind of what that $156 billion that we can expect to pay for that company is worth today. So next, to get the enterprise value, which is the value of the whole company, you take that like exit value, that $131 billion, and you're going to add in all the other cash flows it's going to generate from 2018 to 2022. So you're going to take the cash flow plus the cash flow times the multiple models, the whole enterprise value. Next, you have to kind of clean this up to get the full value of the company if you were to buy them out like with cash. So you're going to take out the net debt, because you assume that when you pay for shares of the company, you're not really paying for its debt. The bondholders are paying for debt. So you're going to take out net debt from the total enterprise value. You're going to add non-operating assets. They didn't really have any. A lot of companies don't, some will. And then you're going to subtract non-operating liabilities. And that gives you like the total. So in total, you think the company's worth about $116 billion. Now we know there's about, there's about 4 billion shares outstanding. That gives Coca-Cola a fair value of $27.11 per share. It's trading at about 54. So this model says that it's extremely overvalued. And one of the reasons it's going to say that is because the 15.4 times multiple, Coca-Cola is trading at a higher EBITDA multiple than the industry. So of course logically that should show under. Their changes in non-cash net working capital have also been all over the place, so it's kind of hard to forecast that. So that's why some years they have really low free cash flow, and then every other year it kind of evens out. So all of these things you're going to want to, so when you get that number, you want to look, how did I get that number? I got $27 because 2019's free cash flow number looks horrible. Well, why? So you want to go back to the model, or what you forecasted, and you say, oh, my change in non-cash net working capital, really, really low, or really high. Do I think that it's going to change by $5 billion, or do I want to adjust my forecast basis? So even at the end of this, you want to go back and make sure that your number makes sense. And if your forecast basis you think doesn't make sense, you're going to go back in and change it and get your new number. It's like the whole thing of this isn't, you want to get a price target that's pretty close to the intrinsic value per share. That's kind of the nature of this. But it also, you want to be consistent, and you want like all of your inputs to make sense. This model is best used in, in most industries you can really use this in. You use this in the tech industry a lot, you see this. Consumer discretionary, consumer staples, materials. You can use this just about anywhere. Some company that's not good in doing is things like financials. You almost never want to value with this. Sometimes also real estate investment trusts, real estate you can't value with this. That's like a whole different class on itself on how to value those companies. But for most of the government sectors, or the government classified sectors, this doesn't. And in most equity research reports, when they tell you the 12-month price target, this is how they got 70% of it. 70% of it was they did this, and they said, well, based on the cash flows it could generate, this is kind of the intrinsic value, this is what I'm paying for.
You said don't use for financials.
Yeah, financials and real estate are really the two you want to stay away from this. And the reason is financials don't generate cash flow, they don't care about that.
Mm-hmm.
All of their business doesn't happen on the statement of cash flows and the income statement.
Mm-hmm.
It happens on the balance sheet. Whether it's commercial lending operations or that's going to happen on the balance sheet. Also, another thing to be careful of when doing free cash flow valuations is that change in non-working capital. If your company has a lot of things that are held on operating leases, you don't want to use free cash flow valuations to do that, because operating leases keep assets off of the balance sheet. They keep them off the asset side of the balance sheet, and they keep them all in equity on the balance sheet. So all those assets and changes in property, plant, and equipment aren't going to show up in your forecast, and then you're going to end up getting some crazy high per share value. And companies know this, because companies know, analysts, they probably use the discounted cash flow to value my company. It's pretty easy to just take your accounting policies and make it so that you can have high free cash flow. That's something to be aware of. If the nature of the business is doesn't generate free cash flow, but their number's insane, it's pretty easy to take your accounting department and tell them, well, you can manipulate the results or make it look like our free cash flow is high. Like, it isn't hard. So that's like the last kind of caution thing when you do this.
How would you go about that then? Not use a DCF model?
You could use residual income, you could use price to book multiples, price to earnings multiples 1 year out, discounted dividend models, probably anything but that, or you could adjust your forecasts for that. Like you can if they're holding assets off balance sheet with operating leases, there's like a formula to adjust for the operating leases, and you can adjust your assets based on that and kind of get a better value. So you can take everything and standardize it all using pretty simple accounting methods. So that kind of goes beyond this. That takes a whole team of people to do usually. So now that we have the last bit of caution in what discounted cash flow is, we're going to go over the residual income valuation. So the idea behind residual income is it's pretty similar to discounted cash flows. What they want to do is you're trying to find the absolute intrinsic value per share. And the way that you do it is how much economic profit are you generating for the shareholder. So the book value of the company is basically how much equity per share you're buying, right? If we take the book value and every year we're going to add net income and we're going to subtract dividends to kind of get our addition to book value. There's a cost the main cost associated with that net income and financing that is typically the cost of issuing equity. So what we want to do is we're going to use the capital asset pricing model to figure out the cost of equity. We're going to use that as our discount rate to get kind of what the next set of residual income and net income minus dividend is worth to you. And then that's what the residual income is. And we're going to take that and add that over a course of 30 years or more forecasted out. And when we do that, we're going to grow it at the terminal rate. So the equation is right under there. So what you do is you take the book value of the first period, and it's the sum of the present value of every period's residual income. So in every period, it's net income minus equity capital times the cost of equity. So minus the book value times the cost of holding the cost of that book value. So it's easier for me to show you the equation and keep trying to explain it over and over again, or how it works. So up here, I took all of the things from the revenue growth and WACC that we calculated in the first week. So our beta, risk-free rate, expected market return, and we got the required return of the equity. So we use the capital asset pricing model to calculate the equity's required return is 4.99%. Next, what I did is I went over the three statement model. I calculated the total shareholder equity, and that equation is only in there because when I made the actual model, I never included a line for total equity. So total equity is simply retained earnings minus treasury stock. Treasury stock's always negative in your retained earnings statement, plus other equity, and then plus other comprehensive income. So then you have the number of shares, and then the book value of equity per share is equity divided by number of shares. So its book value is $4 per share right now. And then we take its beginning dividend, and then I have the terminal growth rate that I calculated, which is the long-term GDP growth over the past 30 years. And the dividend growth rate, I went on Bloomberg and figured out they grow their dividend at about 3%. Next, we took the earnings per share forecast for every single year. So I just took the forecasted net income, or the net income every year, divided it by shares outstanding, and that's how we're there. So the way the residual income thing works for the first 4 years is you're basically going to go through, you're going to plug all these in one at a time. Every year after that, you're just multiplying it by a growth rate, you drag it down and take the present value. So year one, beginning book value. Then we're going to add earnings, then we're going to have earnings per share dividend. To get the ending book value, it's beginning book value plus the earnings generated minus dividends. It's basically how much retained earnings they're generating for you. And then there's the equity charge. So the equity charge is you take the beginning book value times the required rate of return, or the required rate of return on equity. The reason you do that is because it's not free to acquire that equity. That equity costs you something. It costs your shareholders, or they're assuming a market risk of about 5%. So because that equity costs something to generate, you have to account for that. So residual income is the book value that you have at the end, minus that cost of equity, that equity charge. Next, we do the present value, but for the first year, remember the present value is just what it is today. So for 2019, it's just today. Next year. Now this is where you kind of start like looping all your equations together. So you're going to take the ending book value from last year and put it down there. And then again, it's next year's earnings minus next year's dividends, and then minus next year's equity charge. So the equity charge again, we assume that the required rate of return on the equity remains constant. And that's mostly for the simplicity of the model. I couldn't find a real good reason behind that. It's just in order to keep the model as simple as possible, because we don't know what the beta is going to stop. Stock is going to be a year, 5, 30 years from now. So we're just going to assume that this number is probably going to stay about the same.
To get the EPS too, do you just forecast it based on pro forma?
Yeah, so the EPS is straight off the pro forma. So you already forecasted net income, you just divide that by the number of shares, and that's how you get it. Now where it gets kind of interesting is in 2023, because we didn't forecast the net income on the pro forma. That's where we're going to take the terminal growth rate, and we're just going to multiply the book value, or we're going to multiply last year's EPS by the terminal growth rate. So we're just going to assume that earnings grow at the rate of the economy. And the reason this is okay is, one, because it's so far out that the present value of that, if you're dividing something by a number that's getting bigger and bigger and bigger, your end is going to be smaller. So like the actual impact on the present value of that 2% growth, it's almost meaningless. Because the required rate of return on this is 5% and you're growing at 2%, your present value is shrinking exponentially faster than you're growing. So it really doesn't matter if you have it growing 2% like without a good reason. So same thing with the dividends. The dividends just keep growing at 3%. You could use a variable dividend growth rate, or if you want to project dividends, you can go ahead in the first 4 years and edit it. But at the end, you typically just want to have it grow at the same rate, because the impact on the present value, that number gets so exponentially large toward the end that it's always going to go to zero, usually in about 30 years of residual income. So you can see it here. It goes from 416 to 350 in 5 years, and then by the end of it, 10 cents. So, same thing with the equity charge, you're just multiplying that year's beginning book value times the required rate of return. And then once you have that last year, so 2023, where I have everything multiplying by all the terminal growth rates, you just take the equation and the present value and everything and just drag it down until this number goes till it's negative, and then you can just delete the line that's negative and go one above it. And that's it, just add them all up. So it's a pretty simple equation that you're just repeating over and over again. You're letting the present value, you're letting the time value of money basically take the residual income you're generating to zero. Because, you know, I'm sure that $2 per share, the $2 per share you're generating in 2041 after accounting for costs is worth like 10 cents to you today.
So like that, using this model, the end price would be at 49?
Yep, the end price is the sum of every year that there's a positive residual income. And that's actually a lot closer to what the stock's worth $51 as of yesterday, so. This says intrinsically based on the income they can generate, you're left with about $49 of it that many years.
Can you go up to that chart?
Yeah, that's right at the top.
Residual income, ending price, PV, book value.
Yeah, and
And-
residual income. So,
Can you show that formula?
in here,
Yeah.
I'll do it here. So it's the present value of this, and this number is just the ending book value minus the equity charge. So, yeah, that's all this. It's the present value of the end book value minus equity charge.
So what's your okay?
I have a question. So why do you pick 41 years? Again.
So it's picking 41 years. I didn't pick that. Basically what happens is, the whole goal with this is you kind of, with these residual income models, you can assume that basically in the long run everything's going to grow at the rate of the economy. That's kind of the economic assumption,
Mm-hmm.
is that it's in a spot on the long run aggregate supply curve that it will go and go and go with the economy forever. And that's assuming that it's demand and supply is completely efficient. That's like the major assumption here. So what you do is, this may not, in some cases, this might go for 41 years, this might go for shorter, longer. You want to go until residual income is zero. So you're gonna have everything grow at the long-term rate of the economy, and dividends grow at their long-term rate until the company cannot generate residual income anymore. So that shows you the, one, the intrinsic value, but two, how long can how long is this business model sustainable? You can see here that their book value is dropping to 80 cents because their dividend growth is actually outpacing the rate that the company grows. So that kind of shows you two things. And you can read less into the book value, but the whole residual income thing, that's pretty sound. So
Wait, but don't you get the money from the dividend?
when you pay out, yeah. So when you pay out the dividend, yeah, as the shareholder, you're technically getting the money from the dividend, but you don't really, in this like in all of these models, there's one where you do account for the dividends. You don't care about the dividend, you care about the actual, what's the equity with. So the equity and the dividend are kind of, so usually what you would do with this is to kind of price that in. You would use this in tandem with the discounted dividend model. So if we think the dividend growth is going to outpace the rate that the company will grow, we'll use a discounted dividend model and weight that into the valuation to say, yeah, well, this says 49, but a discounted dividend model maybe says 55. We end up at 53, or, you know, the average of that is 53. Shares, stock's fairly valued. So that's the other thing that I'm going to tell you with these models is you don't want to just use one of them and say that's it, because that is not it. Because the discounted cash flows are accounting for free cash free cash flow they generate, and what kind of the average person pays for a company in that industry. Residual income tells me, well, from a purely economic standpoint, this is how much profit it generates to me, assuming that they're paying the cost of equity to finance projects for me to hold the shares. So what people always do is they'll go like 70% one, 30% the other, 60-40, and that's completely at your discretion. Every analyst has different reasons for why they do it. When we did the Brinks one, we thought we did 70-30 discounted cash flow to residual income. We said that discounted cash flow represents kind of how they run their business. They run it to generate free cash flow in the 100+ countries. So we want to account for that. But we also need to account for the fact that they were increasing their leverage, so which produced high ROE. So we used residual income to show that that increased leverage is adding economic profit to the shareholders. Well, it actually wasn't, but we thought it was. And then we, even though the target was low, we kept it in the model because it brings it down to a more realistic number. It shows, yeah, they run their business to generate free cash flow, and it looked great if you only think of it that way. But if you look at other parts, you know, they suck. So you need to kind of weight that in.
How did they, how'd that company ended up doing since you guys pitched it?
It hit our price target like within like 4 months, and then kind of sucked after that. But they did. I mean, they're doing all right. Like, yeah, and then the same with residual income. I just showed you the normal way to do it. There's another way to do it using the company's ROE. That's going to be a lot less common. You're almost never going to need to do that. That's kind of why I did it. I chose to show what was more commonly used. This works in just about this works in every industry, for every company. You can do this. Whether or not you think that it shows the fair value of the company, that's up to you. Like if I take a high growth company like Tesla or something and put it through this, the residual income is terrible. Does that reflect the value of Tesla? Probably not. But it's probably a little higher than the $3 per share that this is going to say.
But does Tesla's actual stock value reflect the accurate value of Tesla?
That's the question you're trying to answer here. Is does their stock value reflect their actual value? So that's all this does. But if I took this and applied it to, I think I actually did it for Kinsale, maybe like $30 or something.
So the 3-statement model,
Yeah.
what other model does that?
Yeah, because you missed it. So the way that you get cash on the balance sheet is not as a percentage of sales like we learned in our class. The way you actually get cash is you forecast the statement of cash flows. So if you go back and watch the video or look at the slides, I showed you how to do it.
Wait,
Yeah.
so they just assume a 20% rate of profit, essentially?
Yeah. So yeah, that's not how you actually do that.
Idiotic.
Yeah. All right. Well, and then next week, have the last part where.
It doesn't make sense.
So we learned.
Yeah. Next week we have more financial models. So next week we're going to do discounted dividends, price to book, price to earnings. Those are like kind of the last three. I'll also like go over briefly some of the real estate ones. I'm not going to do one, but I'll talk about price to FFO and all that other good stuff.